Hey everybody, welcome back to the channel. So a few days ago I did this video about is revenue growth for your stock important, and there was a lot of good feedback and I enjoyed reading the comments, and I thought maybe I should do another video on this topic because there were so many interesting comments. So that's exactly what I'm going to do in this video, and I think it's a topic worth researching further because I do own a few stocks and I am worried about their revenue growth. So the stocks I want to look at today are Walt Disney, Home Depot, and Waste Management. And we'll also look at Alphabet and FedEx a bit later. So on the screen you see the revenue growth of these companies over the last 10 years, right? And I'm going to add in Alphabet and FedEx so that you can see what I would consider, more high growth revenue. So you can see Alphabet has about 526% in terms of its revenue growth over the last 10 years, and that's pretty high. And FedEx too. But you can see the other companies, Walt Disney, Home Depot, and Waste Management, have not increased their revenue by that much. But let's look at their total return price. And you should look at the total return price because that includes the dividends being reinvested. And here, this graph paints a different picture. It shows Waste Management. Although the revenue growth is quite low, Waste Management has increased the highest in terms of its share price, followed by Home Depot and Alphabet. Alphabet, despite the huge revenue growth, didn't do very well in terms of the share price growth. And then we see Walt Disney. The purple line here is the S&P 500, and I use this as a benchmark because basically you want to invest in companies that can beat the market. And you can see that FedEx, although it had strong revenue growth, it could not even beat the market. So if you saw the earlier video, you know that I think operating margin is one of the reasons why some of these companies tend to outperform the market. And you can see that over here. You can see that Home Depot has increased its operating margin by 124% over the last 10 years. Disney has done a pretty decent job as well. Waste Management has done an okay job, but it still increased its operating margin. But you can see that Google has decreased in terms of its operating margin, and FedEx has fallen dramatically in terms of its operating margin. So in terms of Google, we know that Google has had a lot of stiff competition in the advertising business. Facebook and Amazon have sprung up over the last 10 years, and this will definitely eat away into the advertising margins that Google can get. If you look at it over the 3-year median, the picture is pretty much the same. You can see that Google and FedEx have not done very well in terms of improving their operating margin. So I think it's important to look at operating margin, but I just want to issue a caveat here. There could be some instances where a company will increase its operating margin by taking on a lot of debt. So I think the other important financial metric, and one of my favorite financial metrics to look at, is the return on invested capital. You want to see the return on invested capital increase as well. Now the return on invested capital includes the operating profit divided by the net assets of the company and the debt of the company. So it includes the debt in the calculation. So you can see that Home Depot has still managed to increase its return on invested capital, and so have Walt Disney and Waste Management. But let's look at Alphabet and FedEx. So in terms of FedEx, they have definitely not been able to increase their return on invested capital. It's dramatically fallen. And even Alphabet, their return on invested capital has fallen quite a bit. So why is this important? As you know, I have a real money portfolio, and Google is actually one of my favorite and one of my top holdings actually. You can see Google makes up about 11% here. And I have the other class as well, which is another 3.5, so almost 14%. So Google still has strong revenue growth, but there are other companies that I hold that have declining revenue growth. Booking is an example of that right now. So Booking has decreased in terms of revenue growth from the high double digits to the low single digits, and the revenue may even decline. But does that mean I should sell Booking? I think I should look at the operating margin as well, right? And I want to guard against the temptation of selling a stock just because revenue growth has slowed. Um, Even Visa will have revenue growth slow over time, and it is slowing a little compared to its past performance. But I don't think I will be selling Visa anytime soon because it has very strong operating margins and strong return on invested capital metric as well. So I hope you enjoyed this video, and I hope you learned something about the return on invested capital and how important that is, along with the operating margin. And if you'd like to see more such videos, give me your suggestions and comments below, and I will look into that and try my best to do research. Thank you and have a great day.